Is SCHD safe if Schwab goes bankrupt? And what happened to investors in the past when ETF sponsors actually did go bankrupt? Hello, members and super savers. I hope you're having a good week. This is what I'll be covering in today's video because, well, these are two of the top questions you sent our way recently after we posted this video on Charles Schwab, which I've linked in the video description below for easy reference. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks, so that as many of you as possible can sleep just a little bit better tonight. First, a brief intro to SCHD for those of you who are newer to Schwab, as well as for those of you who own Schwab ETFs other than SCHD. At its core, SCHD, the Schwab US Dividend Equity ETF, is an exchange-traded fund. And like all other ETFs, and also like any stock, individual investors can buy and sell SCHD on the stock market. In our mind, there are three primary reasons why so many investors have SCHD in their portfolios. One, SCHD aims to distribute a high dividend to fund investors every quarter. SCHD tries to track the total return of the Dow Jones US Dividend 100 Index as closely as possible before fees and expenses. This means that SCHD, mirroring the index, will invest in about 100 US stocks that promise a high-quality, sustainable dividend return in the US market. Two, SCHD, like many other ETFs, can be very cost-efficient. Its expense ratio, what it charges investors for expenses, is 0.06% per year, or 60 cents per $1,000 investment. 3. SCHD has been a media darling for quite some time now, as you can see from these headlines, going back at least as far as last year. In fact, SCHD is one of Schwab's most important in-house investment products. Schwab's asset management arm manages more than 100 funds with over $870 billion in assets under management at the time of this taping. And SCHD alone accounts for about 5.6% of that total number, with more than $49 billion in net asset value. No surprise then that so many of you in our super saving community own some SCHD in your investment portfolio and have asked about what would happen to it if Schwab were to go bankrupt. Do keep in mind as you go through this video that while we're primarily focusing on SCHD, the conclusions that we derive here from our analysis of SCHD can mostly be applied to the other ETFs in the Schwab family of funds, the funds managed by Schwab Asset Management as well, which is a great segue into the top of mind question about SCHD for today's video. So, I'm actually curious, how many of you know what happens when you click that buy button for SCHD? Drop us a comment and let us know, because it's important for you to understand this first in order to fully ascertain how safe SCHD may or may not be in the event Schwab were to ever go bankrupt. Let's say that you want to buy one share of SCHD. When you click that buy button in your Schwab account, or any other brokerage account for that matter, your money gets sent via your broker to an exchange, because SCHD is an ETF, and ETFs are traded on exchanges, just like normal shares. To keep this example simple, I'm going to assume that you're buying the share of SCHD from an authorized participant, usually also a large brokerage firm, which is also a market maker and hence continuously active in the buying and selling of SCHD. The exchange then sends your money to this authorized participant, and the authorized participant sends the exchange one share of SCHD, which is then passed on to you, again via your broker. So where does the authorized participant get its SCHD shares from? From Schwab Strategic Trust, which is the entity that houses SCHD's legally owned assets and ultimately responsible for issuing all new SCHD shares. For tax reasons, the authorized participant usually doesn't pay for new SCHD shares in cash, but in kind, meaning the authorized participant delivers the assets, the securities, to be held by SCHD to the trust. And in exchange for these delivered assets, these delivered securities, the trust sends a block of equally valued SCHD shares called creation units to the authorized participant. And that's where the authorized participant gets its SCHD shares from. And the same process with creation units that we just outlined for buying one share of SCHD, it works the other way around if you were to sell, to redeem a share of SCHD as well. As you can see from SCHD's latest prospectus, one creation unit was about $3.9 million. And with these sizes, creation units will normally only be issued to large brokerage firms and institutional investors who have signed an agreement with the fund and are not available to retail investors like you and me. Most ETFs, like SCHD, have multiple authorized participants, often including large banks such as Morgan Stanley and large brokerages such as Fidelity. Do keep in mind that this is a high-level overview. The role between authorized participants and the trust that houses SCHD's legally owned assets can get fairly detailed and, quite frankly, would require its own separate video. What I wanted to show you with this illustration is how SCHD's assets, its underlying securities, get into the Schwab Strategic Trust entity, which begs the question, who created this trust and who created SCHD? Because this trust and SCHD did not appear out of thin air. Every ETF, including SCHD, has a sponsor who sets everything up. And in the case of SCHD, that sponsor is Schwab via Schwab Asset Management. Once the sponsor sets up the independent trust and the ETF, it will often also enter into an investment advisory agreement with the new ETF. In SCHD's case, Schwab Asset Management has such an advisory agreement to help manage SCHD and its investments. And in exchange for these services, the trust pays a fee to Schwab Asset Management, basically SCHD's expense ratio. But back to the sponsor setting up a new ETF. When a responsible sponsor sets up a new ETF, that sponsor will usually opt for a structure that is as bankruptcy remote as possible to protect their investors and clients. Bankruptcy remote means that if the sponsor and/or investment advisor were to go bankrupt, this would not impact the ETF's assets, what it owns in its portfolio, which rightfully belong to investors. So the ETF's assets must not be available to the creditors of the bankrupt sponsor and/or investment advisor. Rather, the ETF's assets need to be insulated from the bankruptcy and remain solely in the possession of the ETF and its investors. However, not every ETF is alike, and to really understand the setup of an ETF and what might happen in a bankruptcy, we need to dig a fair bit deeper into that ETF's prospectus and legal paperwork, which is what we did with SCHD for all of you. And here's the first bankruptcy question that SCHD's prospectus and legal paperwork answered for us. Question 1, is the legal structure of SCHD as bankruptcy remote as possible? And the answer is yes. Schwab has set things up so that SCHD's legal structure is properly bankruptcy remote and should safeguard investor interests if worst came to worst, just like it has for its other ETFs, as far as we can see. As we've just shown you, Schwab Strategic Trust houses SCHD's legally owned assets. The trust is separate from Schwab Asset Management and has its own officers and board of trustees. This means that the trust insulates SCHD's holdings from any potential creditors that Schwab might not be able to pay in the event of bankruptcy. Furthermore, the actual assets of the trust and SCHD upon purchase are held by State Street as custodian and fund accountant, meaning that State Street, as an external entity, is responsible for the safekeeping of the securities and cash held by SCHD. The custodian adds another layer of protection if anything were to go wrong, as State Street would not be allowed to deliver any shares, underlying securities, or cash to anyone not authorized by the trust and its officers. Again, making sure SCHD's assets remain in SCHD. So, if Schwab were to go bankrupt, the assets of SCHD would still be available to its investors, and its investors only. Schwab could not access these assets to pay its creditors, and the creditors themselves could also not lay claim to SCHD's assets. In our mind, this is as good as it can get in terms of the legal structure of the fund. Now, because I know you're a smart and savvy bunch here on Diamond NestEgg, some of you are probably thinking the best legal structure may not be of much help if the people who are making the decisions in times of crisis, these folks here, crumble under the pressure, which brings us to the second bankruptcy question that SCHD's documents answered for us. Question 2, are the people who will actually sign off on key SCHD decisions in times of crisis independent? Do they have the best interests of investors at heart and mind? In the case of SCHD, it's the trustees here who are ultimately the people who will decide on what the trust will do in case something terrible were to happen, and to ensure that the trustees will always prioritize the interests of investors first. Generally, a majority of trustees should be independent, meaning not tied to Schwab. And this is the case with Schwab Strategic Trust, which as of June 2023 had 2 interested trustees with close ties to Schwab, namely Walter Bettinger, Schwab's co-chairman of the board and CEO, and Rick Wurster, president of the Schwab Corporation, but also 8 independent trustees with no ties to Schwab outside this trust mandate. Which brings us to the third bankruptcy question that SCHD's prospectus and legal paperwork answered for us. Question 3, is the underlying asset structure of the ETF bankruptcy remote as well? So, a trust may be legally bankruptcy remote and have the right independent people making the decisions in times of crisis, but this will all not help if a bankruptcy or any other period of financial distress will impact the assets that underlie the ETF. And for a straightforward index replicating ETF like SCHD, the most conservative approach is to own as many of the underlying assets, the shares, outright, and not to resort to complex financial engineering with derivatives such as total return swaps that would mean that the ETF would not actually own the underlying assets outright, but only have a claim against a counterparty that could be affected as well. And here again, the documents show that Schwab has set up SCHD in a way that investors cannot object to. According to its summary prospectus, SCHD has a policy of investing at least 90% of its net assets in the stocks that underlie the Dow Jones U.S. Dividend 100 Index. In fact, as per the latest portfolio holdings report as of May 31st, 2023, SCHD held 99.7% of net assets in the actual stocks underlying its reference index. No complicated total return swaps or derivatives constructions here, and also no substantial exposure to Charles Schwab as a financial counterparty for any of the assets as far as we can see. So it all looks good from the documents, I have to say. 1. SCHD's legal structure is as bankruptcy remote as possible. 2. 80% of the trustees, the people who make and or supervise the key decisions in a worst-case scenario, are independent from Charles Schwab. 3. The underlying asset structure of the ETF is bankruptcy remote as well, as the trust holds more than 99% of its net assets directly in the equities it's tracking. So no discernible counterparty or credit risk here either, which is a great segue into the final section of our video today. While ETF sponsors don't tend to go bankrupt very often, there are a few examples from the last financial crisis in 2008-2009. ETF sponsors that ran into financial trouble during that time included both well-known names such as Lehman Brothers and Bear Stearns, but also smaller specialist firms such as X-Shares and Craymore. So from what we could find out, it seems the process worked as it was supposed to in 2008-2009. There were 2 general groups of outcomes. The first group were firms that actually went under, such as Lehman and X-Shares. The trustees of the affected ETFs seem to have taken control and replaced the bankrupt firm as investment advisor as appropriate, in effect mostly severing the ties with the bankrupt firm. As a next step, the ETFs affected went into liquidation, meaning that the underlying holdings of the ETFs were sold off and the proceeds returned to investors. The second group were firms that were acquired, such as Bear Stearns, which went to JP Morgan, and Claymore, which went to Guggenheim. The outcomes here were more diverse, as the acquiring firms sometimes opted to continue the ETFs under new ownership. Guggenheim, for example, opted to continue some of the funds for a while under the name of Claymore Guggenheim. What remained the same in both instances, based on what we found, was that investor interests were protected as much as they could be under the respective structures. The system worked, so to speak. And of course, we hope that we won't see a repeat of such testing times anytime soon. Now, if you're interested in learning more about what else we've distilled from Schwab's latest publicly available data, then be sure to check out this video here that I referenced earlier to see which of Schwab's numbers are looking good and which are looking a bit less good currently. It's linked below for easy reference. So, I hope that this video has answered your top of mind questions as it relates to SCHD and bankruptcy, or for most ETFs and sponsor bankruptcy for that matter. And will this help you sleep better tonight? Drop a comment below and let the community know. Do keep in mind though, we are not legal advisors. What we've shared with you today is based on decades of interpreting financial and other information from documents similar to these ones from Schwab. And as always, if you enjoyed this video and learned something new, I'd love to invite you to continue to support our channel through membership so that we can keep producing one-of-a-kind, unbiased, sponsorship-free videos for a super saving community. Get your questions answered in our next live member Q&A on September 22nd at 5:30 p.m. Eastern Time. And check out our latest member videos. This one is hitting soon. To learn more about Diamond NestEgg membership, visit our channel page or the join link in the video description below for more details. All right, members and super savers, if you have other SCHD or other ETF holding super savers or super savers that you care about, be sure to share this video with them so that they can be as financially savvy as you are. And of course, hit that thumbs up and see you again very soon with more brand new wealth building content for your financial journey.